Rick, how do you handle that if you're a European investor? What's the trickle-down effect?
In terms of European credit?
U.S. corporate credit, meaning in a light that hedging is so expensive.
Yeah, I mean, the demand for U.S. credit, I mean, there's still a big demand because the pension insurance demand is still tremendous. I mean, there was a big bank deal yesterday. Once you move the price back a little bit, you still see there's a lot of demand out there. However, like you say, the hedging costs, particularly for places like Japan, are more expensive. And quite frankly, the incremental spread you're getting when treasuries are giving you this sort of yield, it's just not that interesting relative to where you can get other yields in the marketplace, relative to, quite frankly, to where you can get beta in the market, i.e. equities, where you have a more, what I would argue is a more convex risk-reward paradigm.
Well, one foreign investor that's been a big seller is U.S. companies, because they've been liquidating their overseas holdings, or overseas, I want to put in quotes, of U.S. corporate debt. And you've seen this kind of distorting the market in interesting ways. And one of my big questions right now is, at what point are people going to come in and take advantage of some of those distortions? In other words, you're seeing yields on shorter dated U.S. credit blow out, and actually right now, 10 to 15-year U.S. investment-grade credit is offering the smallest premium over 1 to 3-year investment-grade corporate credit since 2009. So my big question is BlackRock getting in? Are they buying up short-term corporate bonds?
You're going to hurt all our secrets on this show. There is no, I mean, it's exactly right. We've been picking away at the front end of the curve in all assets in the front end because, like you say, why go out to the back end in some of these assets when, something very different is happening. When rates move higher, traditionally spreads tighten. But when rates move significantly higher, you don't need that incremental spread anymore. So you actually start to push spreads out at a certain point. So anyway, we like being in the front end. As you said, there's been, because of repatriation, there's an interesting dynamic about companies selling their debt to buy back their equity, which has been immense on the other side of it. So we've been picking away at the front end of the corporate curve, as well as other assets, secured assets in the front end. 100% right.
What about leveraged loans and CLOs? Especially if we wind up getting more issuance if we have some rollback of regulation in D.C. in terms of what banks can lend to.
So, if you said to me today what makes sense in a portfolio, loans, floaters generally make sense. There's parts of the market, though, where people are surging in to buy floating rate debt, no matter what it is. And
Chris Ailman is buying floating rate debt. Right. He just told us.
So you got to be a little bit careful, and we try and find. By the way, in fixed income, you got to look to find the diamond in the rough around a lot of stuff that's too high. We like loans today, but covenants, as you've talked about, covenants are coming off quite a bit. But we like loans. We also like other floating rate debt. But parts of the market, like the commercial mortgage market, people are paying up like crazy for. I just want floating rate debt because I can't hedge it for places that can't hedge it organically. Many times we'll buy corporate bonds and just hedge the duration so as we don't have to pay up for a floater.